Okay, a very warm welcome to you all this morning. Financial Fitness Friday is our second event of 8. We'll see how we get on. If you guys really like it, then we'll do more. We had a very successful event last week. Thanks very much for those of you that attended, and welcome back to those that were, and welcome to the new people that have jumped on ever since. So this is 20 minutes, half an hour of financial well-being content. We try to deliver it in a human way, personable, fun and easy to understand. And then we're also going to ask you guys to help us design the future of this. So we kind of kick-started the whole thing, and what we'd really like to do is to get you guys, if possible, to do some feedback at the end. So when you close down your Zoom meeting, you'll be sent straight to a survey. Take you 1 minute. Just ask you, please give us some feedback. Let us know what you felt about today, if it's working for you. If there's any thing you think we missed out, or suggestions for the future, let us know. If there's some constructive criticism, please let us know, because we want to keep fine-tuning this to help make it a better experience for people going forward. And we want to spread the word. We want to grow this thing, There's no strings attached to this. It's a bit of PR for us, but we're just doing this, for free. There's no strings, there's no selling, there's no pitching, there's no nothing. It's just pure financial well-being, fun and games, and hopefully you'll get some real value out of it. But we're looking at this from a slightly different perspective than most people do in this kind of space. We're focused on financial well-being, okay? And financial well-being is a bit different to just financial education. And financial education can be a bit dry. We want to bring the two aspects of this together. So in order to succeed in anything in life, the key thing is that 80% of any success in life is psychological. And the same goes for financial well-being. So what is financial well-being? Well, financial well-being is just a feeling, really. It's a feeling that we feel in control. If you feel in control of most things financial in your life, then you tend to not feel stressed. And if you feel out of control of most things financial, then you might be stressed. And that has a really negative impact on all the other aspects of well-being. So if you do have financial worries and anxieties, it's very difficult to get your emotional, your mental, and your physical well-being sorted out. So they all kind of work together. So we're focused on this particular bit. 80% is psychology, the 20% is the mechanics. And we've got a guest today joining us called Jamie Smith. He's a rising star in our business. He's a young, the face of Foster De Novo. He's a young financial advisor who's doing really well. And he's going to share some of the other element, the 20%, which is the mechanics, the strategy. But it's very important to have both aspects. With financial well-being, it's really important that we have the mindset right and the confidence, because a strategy won't work without that mindset. But at the same token, if we have the wrong strategy, we won't get the results either. You're not gonna see the sunset if you run east, for example. Okay, so I've got a few slides I'm going to go through. Then I'm going to bring Jamie in. We've got a few questions for Jamie. There might be a few questions afterwards as well. But I want to share also some thoughts with you about what is it that drives investment. Today's about investments. We're going to try and keep it simple. We want to give you the confidence with investments. A lot of people get put off, and in the UK, we are kind of bad in a way, because we tend to invest money just in cash. And I showed people last week, the impact of inflation on cash. We need to also look at if we've got a long enough term to actually get some of that money working for us, so that we're making money while we sleep. But the most important thing is we need to know what we want, and we need to know why we want it. So let me just bring up a few slides, and I'll share with you some of my thoughts. But what are the key things which drive investment decisions? Well, I'll tell you what they are. They are fear and greed. So let me just go back. I've jumped ahead there. Okay, what drives investments is fear and greed. So we've all experienced the stock market going down, and that brings about a certain element of fear, and that makes emotional decisions for us. We make those decisions based on that. All decisions we make are emotional. So the other thing that drives it is greed. And if you look at some of the best investors out there, if you look at Warren Buffett, for example, one of his sayings is that be fearful when other people are greedy, and be greedy when other people are fearful. So it's almost saying do the opposite of what everybody else does based on how they're feeling about their money. So, and again, why this is so important from a psychological perspective, and what we want to do with our finances is to feel resilient. Financial wellness is a good feeling. The quality of our life is how we feel every day. So if we feel good every day, that is our life. So let me share with you a graphic. So there's an individual there. We want this individual to become much more financially resilient. And this person's got some goals and dreams over there, but they're not particularly big. And there's a brick wall in the way. This is an obstacle in life. Life presents us with an obstacle like that brick wall. And if the goals and dreams aren't very big, the obstacle becomes psychologically big, and it is bigger than the goal, and it stops us. It stops us in our tracks. Sometimes we can't change what life presents to us. We can't change, we're out of control of certain things in life. But one thing we can control is where we focus our mind and what we want. If we know exactly what it is in terms of our goals and objectives, if we know exactly when we want it and why we want it, the big why is a crucial thing. As you can see there, when the goal in our mind and the objectives of our financial objectives are bigger than the obstacles that get presented to us, we can find a way over it, round it, through it. And this is what builds financial resilience. Okay, so this is a really important part of this, to make sure that we have big goals and have clear goals, specific goals, realistic goals. And once they're clear in our mind, then we can approach the strategy. We can approach the strategy with confidence. Now, some of you might have seen the headlines. You go back to the end of March. Okay, this is where the emotion kicks in and the psychology kicks in. If you look at that graph there, that shows the FTSE 100 dropping like a stone, and this was the start of the COVID pandemic. And the media jumped on this and told everyone doom and gloom, 30% drop in the stock market, and put the fear into everybody. Now, there is a kind of a reaction to this. For people that don't quite understand, the reaction is to sell and get out of the market when they're down. But I know what our advisors did at the time. They told people to invest. They were telling them to invest at that time when things are cheap. And this is kind of counterintuitive. And this is where we need the confidence. This is where the psychology really kicks in for us. So if you look there, this is the end of the second quarter. There's been a rally ever since. And so you can start to see that when people were told to invest, they've made quite a bit of money during that recovery. And if you've got some money in American stocks, for example, I think the US Standard & Poor's 500 is only down about 4% over that period. So actually it has bounced quite significantly. But where is the media headlines on this? You don't get it. So they leave us in fear. So what we need to do as individuals, we need to get more confidence. That can come with more information and more knowledge. We can make much more rational decisions. But we don't, what we mustn't do is allow the emotion to force a decision. We need to get more information. A couple of things I want to share with you here, just again to help with the psychology of this. You've heard of bull markets and you've heard of bear markets. Well, a bull market is when the markets are going up, and a bull actually attacks with its horns up. So that's where we get the word bull years, a bull market. A bear market, a bear strikes down with its paw. So therefore a bear market is when the market's going down. So if you look at that there, you can see the bull markets, these the red sections, they are much bigger than the bear markets. And if you look at that period there, this is going back to the start of the 20th century, 1900, you can see there's 103 bull years and 16 bear years. The average bull period, 7.9 years, and the average bear period, 1.3 years. So when you know this kind of thing, when you know this kind of stuff, it really helps with your psychology. It helps you be brave and hang on in there, So more information, the better, to give you confidence, to help your psychology make better decisions. Because as I said, 80% of your success in investment will be your psychology. So that leads me to then, if we're going to have goals, what goals do we need? We need 3 goals, really. We need 3 buckets of our financial planning. And most people, if you work in an organization, you've got a pension scheme, which is your long-term, but we also need short-term, medium-term, and long-term objectives. And depending on how long that objective is away, that will dictate how you invest the money. So Jamie's going to share some of that with us in a moment, but I'm just going to focus on one of these things. I think probably, possibly the most important one, which is the short-term. Have we got an emergency fund? Now, there's lots of research out there that I read, and it quite clearly states that something along the lines of half the working population in the UK couldn't get their hands on £1,000 in the event of an emergency. Well, that's a worry. Imagine that. Imagine if everybody had an emergency fund at the start of the COVID pandemic. If everybody had goals and objectives, they got short-term, medium-term and long-term goals, and they've got a plan to achieve them. And those goals are clear, they're specific, there's a monetary target, okay, there's a time scale, and they've started to work towards that. Can you see how that would build so much financial resilience, and that resilience is really a psychological thing. It means when we have a problem like a COVID-19 pandemic, we're better positioned, we're in a stronger place for it. So what is an emergency fund? Well, what's it there for? Well, we have bills that come at us. It's not literally to pay the bill. It's there for a reason. These are things that happen in life. We've got to find the money. If we haven't got the money, we have to find it from somewhere. So what is it really there for? It's to avoid high interest debt. It's to avoid overdrafts. It's to avoid credit cards. Because if we've got those kind of high interest debts, I'm not talking about mortgages, which are low interest and they link to an asset, which usually goes up. This is the toxic debt, the credit cards, the overdraft, the payday loans. And if you have this kind of thing, then it's a bit like driving the car of life with a handbrake slightly on. Okay, we don't want to be there. So it's really important that we understand that we've got to get our mind right, our goals right, our confidence right, all of those things in order to be successful with our finances. So what I'm going to do now, I'm going to introduce the lovely Jamie. So I'm going to stop that share there. So Jamie, are you there? Welcome.
Yes, I am. Yeah, good morning, Darren. And good morning to everyone else on the call. It's great to see so many people supporting this and keen to get financially fit. So and also, Darren, thanks for your kind words. It's been a while. Been doing this job for 15 years, so it's been a while since somebody called me young.
Yeah, so, but the average age in our industry is pushing about 60, Jamie. So you are very young. Very, very, very pleased to have you here. Thank you so much for your time. Now I've got a few questions for you, and these are questions that I think that we've asked people from last week what sort of questions they've got in their mind. So I'm going to get straight onto that, and then I think you've got a couple of slides you might use to demonstrate some of the answers. So question number one, Jamie, is for people looking to invest, what are the main things they should consider?
Yeah, right. Okay, so what I've done is I've come up with 3 basic rules for investing. So I could have easily come up with 5. I could have come up with 10. But when forced, try and keep it as simple as possible. These are my 3 basic rules. And actually, you've covered off the first rule pretty well, Darren, it has to be said, which is having a suitable emergency fund. So I won't go into too much about that. We've talked about the reasons why people should have an emergency fund. And I know for many out there, it might be a bit of a luxury having some money just sat in instantly accessible cash. How much might people want to have? Well, that very much depends. Typically, we'd suggest at least 3 months, whatever your basic monthly outgoings might be. So your mortgage, rent, bills, that kind of thing. But just because people don't have that amount, it doesn't mean that they shouldn't consider to start investing. They might just want to do a bit of both. Save towards their emergency fund and start saving for the longer term at the same time. So rule number 1 is have an emergency fund. Now, what's rule number 2? So this is all about a minimum investment term. So people who are considering investing shouldn't intend on withdrawing or touching those savings for at least 5 years. Now, there's a reason for that. It doesn't mean that they can't access those savings. I mean, but it just means in the sort of worst case scenario, it's a kind of a last resort when they need to access those savings. And the reason is because if you look at most, not all, but certainly most 5-year investment periods in the financial markets, you would have seen some sort of positive return. Now, if you look at terms of less than 5 years, there's a greater chance and increased likelihood that you might get back less than your original investment. So 5-year minimum term is what we'd recommend. If you've got even longer, fantastic. 10, 20 years, even better. And what's my last rule? Well, my last rule is a balanced approach. And what do I mean by balanced approach? Well, quite simply, you just want to avoid having all of your eggs in one basket. Diversify and spread the risk. And there's lots of different types of investments out there, and investors that's what they should try to achieve, spreading across all those different types of investing. And the nature of investing, Darren, means that there's there's winners and there's losers out there. And what do all investors want to do? Well, they want to obviously avoid the losers and pick the winners, but we can't do that all of the time. So that's why it's important to diversify across lots of different types of investments. Does that make sense?
That's brilliant. Thanks very much. Now there's a lot of jargon in financial services, and it's very difficult when I think you're in your position to avoid it at times. But there's a lot of big words out there, and I know there's one word which it does confuse a lot of people. So the question is, what is volatility, and is it bad for investments?
Yeah, it's an interesting question actually, because often when we think of something being volatile or someone being volatile, we can think of that in quite negative terms. But when it comes to investing, actually, volatility is actually a rather positive thing. So what do we mean when we talk about volatility? Well, in very simple terms, investments fluctuate in value. That means they go up and down in value. Now, often people, as we said, they fixate on the negative part of that. When it comes to investments, they focus on the investment going down in value. But again, the nature of investing, if something can go down in value, then it can also go proportionally up in value as well. And investments that go down, up and down more in value are said to be more risky. So the key for any investor out there is to decide what level of fluctuations they are comfortable with. Now, I've come up with this chart, you can see here, and I call this the investment journey. So that's what people should think about when investing their money. What sort of investment journey do they want? And I've got 3 example portfolios here. So on the bottom, we've got the red line, and the investment journey you can see is nice and smooth, not many fluctuations at all in the value of the investment over time. But actually, the returns aren't that exciting. Whereas by comparison, if you look at the blue line, it's a bit more volatile, more ups and downs, but you can see there much higher in value, a much more exciting return. Now, in my experience, when you sit down and talk to people about that, you talk to them about volatility, fluctuations, and most people will say, do you know what? I want to be somewhere in the middle, which is the orange line. So it's just about exploring that. Some people may choose to have different levels of volatility, different levels of risk for different pots of money, and it's just about choosing which is right for you.
And how do you work out with a client where they are? I mean, how do you get to that point?
Well, it's not a perfect science, I have to say. Volatility and how much fluctuations people are comfortable with is often a psychological thing. So we ask people to complete a bit of a questionnaire. It's sort of psychometric testing in a way. It's multi-choice, and it gives us a starting point. It's a framework to have that discussion, if you like. But actually, that can change over time. People's psychology, their tolerance.
It's the psychology again.
Exactly, and I'm sure that people can be rather bullish on the market, but suddenly you get a big market drop, and their tolerance for volatility can suddenly change. They've read something bad in the papers.
Do you notice people's confidence grows over time, and they're more prepared to take a more volatile strategy?
Yes, I do, and I think time is very important with that as well. And generally, the more time people have to invest, the more volatility that they're typically comfortable with. So that's really important factor as well. And it may be if somebody's in their sort of 20s or 30s, they've got and they're saving towards retirement. They've got a 20, 30, 40 year perhaps investment term. They may be more comfortable with higher level of volatility compared to somebody who's perhaps saving, for 5 or 10 years. Perhaps they're saving for a house deposit. So they want minimal fluctuations. They want to take less risk with their savings.
Okay, that's brilliant. That's really helping me understand it as well. And the key thing here is that can you have a slide, I think, where you can show people what's the best way of investing their savings. So I think you've got a slide just kind of paints that picture, because people are a bit confused as to what these funds look like.
Yeah, absolutely. Yeah, you mentioned the word fund. I just want to say what we don't want people doing is going out there choosing their own investments. So we don't recommend people going out there and deciding which companies to invest in, for example. That is really high risk, and that is best left to the professionals, the people who live and breathe this investment stuff. So generally, how we'd recommending accessing investments is via a fund. And I'm just going to share with you how a fund actually works, because I'm sure lots of people will have heard of that word, but what does it actually mean? Now, a fund is a kind of a pot of money. But with that, in that pot of money, you've got hundreds of different people, often thousands of people, of different people saving into that big pot of money. And that pot can be worth billions, if not millions and billions of pounds, tens of billions of pounds, some of the biggest funds in the world. Now, what happens to that pot of money? Well, you need a fund manager. And the fund manager, their role is to choose how to manage that pot of money. So essentially, investors are using the skills, the expertise, the knowledge of that fund manager to manage their savings on their behalf. And what the fund manager will usually do is they will invest that money. And going back to my third rule of investing, remember, they will invest the money across lots of different investment types here. So I'm not going to go into those investment types, but I think that would be quite a useful session perhaps for the future, yep. Darren. But ideally, new investors want to invest in a diversified fund, a balanced fund, where you've got somebody managing your investments and investing in lots of different investment types.
Does that help? That's a really good summary. Thank you, Jamie. I think there's another couple of things which people get confused about, which I hear a lot, and that is passive and managed. You know, so what are the main styles of funds, and what are the difference between them?
Yeah, I think this is actually quite an interesting question, and I'm on a bit of a mission to educate people about these two things, because once you understand the concept of funds, the next step is to understand the different styles of funds. And do you know what? It's pretty simple, because there's only two main styles out there. I'm just going to share my screen with you again. So the two main styles are active and passive funds. Oh, sorry, I got the wrong slide there. We've got active and passive funds. Now, what's the difference between the two? Well, passive funds, otherwise known as tracker funds, what's the purpose? They're trying to track the market. So let's take, for example, a FTSE 100 tracker fund. That's trying to replicate the performance of the FTSE 100. So very simply, if the FTSE 100 goes up 1%, that's what your fund's going to do. That's what you're investing. 100,
just for people.
So the FTSE 100, yeah, for people out there, is the 100 biggest companies in the UK.
That's it.
So if you want your investment to track the performance of the share price of the 100 biggest companies in the UK, you'd invest in a FTSE 100 tracker fund. And conversely, if the FTSE 100 falls, guess what? That's what your investment's going to do.
Okay.
Now, the great thing about passive and tracker funds are that they're pretty low cost. They're only about 0.5% per annum. In fact, I know that there's funds out there for even less than that, about 0.2% per annum. But there is a bit of a disadvantage here, because when would you not want to be invested in a tracker fund, a passive fund? Well, obviously, when the market goes down. So you wouldn't. I wanted to be in a passive fund around sort of February time when the market go down, particularly in that FTSE 100 tracker, because guess what? You still be sitting on an investment that's lost about 16, 17, 18% in value at the moment.
Okay.
But passives are great when the market's going up, because you're going to track the market at a pretty low cost. Now, what's the alternative to passive funds? We've got active funds, and active funds are actually trying to beat the market. So why wouldn't you want one of those? Why wouldn't you want a fund that's trying to beat the market? Well, the reason is because A, they're a lot more costly than passive funds. They're about 1.5%, so a whole 1% more. And the reason for that is because, again, you are basically buying the skills, the expertise, the knowledge of a fund manager or an investment team. Now, there's lots of research into active funds. And research shows that there is a bit of a consensus that the majority of active funds actually don't beat the market. It's quite a large minority that actually do. I think it's estimated to be about 40%. But it could be a double whammy for investors. If you're invested in a poor active fund, you're paying higher charges and you're not getting the returns. So something to consider. However, active funds are the only style of funds that will give you that downside protection. So when the market's falling, You've got a fund manager, an investment team there that can put the brakes on, hopefully, that can cushion some of the losses. Now, me and my colleagues often talk about which is better, passive or active. But for me, it's not like that. It's about having the best of both flavors. You want a blend of the two. And what sort of blend you want really depends on your individual situation.
Well, that's a really useful explanation there, Jamie. Thank you very much indeed. So now, not most people out there in the society, they cannot afford the luxury of a financial advisor like yourself. Okay, most ordinary people can't access them because you guys are very expensive. Okay, and I know you can say that there's value in that, and of course, most people that take advice are better off in the long term. But for the majority of people, if they want to get into investments, I think we're talking today, giving people some confidence with knowledge. We also need to make sure that people have the right goals and they set their goals and they've got their objectives and their wants and they know why they want it. But then they want to go and do something, but without an advisor. How can they invest if they don't want to use an advisor? They can't afford an advisor.
Yeah, you're absolutely right. There is a bit of a conception there about the cost of financial advice and not being as accessible for many people as it should be. But there are some solutions out there.
Right.
So I think that for investors, for people looking to invest for the first time, and perhaps they don't have they have relatively small amounts of surplus income that they have spare, so perhaps as little as £20 a month, for example. There's a particular type of investment solution that I think is ideal for this type of investor, and that's known as Robo Advice. Yep, so the Robo stands for robots. Yes, I know, it's pretty scary. We've got robots giving us advice. I mean, if that's what the future is.
Wow, okay.
but there we go. Now, how these Robo advisors work, it's an online proposition, and investors would essentially follow a decision tree. So there's lots of questions there about what somebody's looking to achieve with their savings, and also lots of questions there about somebody's sort of tolerance for investment risk, going back to those fluctuations, the volatility, how much are they comfortable with? And once they've answered all those questions, then out pops a recommendation, an outcome. And they will help somebody to choose what funds, what portfolio of funds might be more suitable for them. And these propositions are pretty low cost as well. Now, there's a couple of good ones out there. Personally, not a recommendation, but personally, I like Hatch. And the reason why I like Hatch is because they help people to understand how much they should be saving to achieve a particular objective. So if you want to sort of retire at a certain point, they help people to understand how to do that. That's
probably, I would say, is that the most important aspect, is being absolutely clear on the outcome first, and then back with the strategy. And Hatch they provide that short-term, medium-term, and long-term, I believe, objectives.
That's right. Yeah, absolutely. And when we talk to anybody about what they're looking to achieve, we always focus on, as a starting point, what their objectives are, what they want their money to do for them.
Brilliant.
Maybe they've got different objectives, some longer term, some short term, some more medium term. We need to identify what they want their money to do for them. And there's another one. In fact, I've recommended this one to my wife. It's called Moneybox, and this one's quite clever. I'm sure some people would have heard of it out there. But every time you do a transaction on your bank card, let's say you buy a coffee for £2.50, what Moneybox do is they round that transaction up to the nearest pound. So they'd round it up to £3, and they would save automatically the 50p. So if you imagine you're transacting quite a lot on your card, all those small transactions, they start to add up over time. And it's a really easy way of saving money without even knowing it. And what Moneybox will do is they will invest that money as well.
Brilliant. Now, I know I'm conscious we're running out of time, but I think I'm going to push it and overrun by a few minutes, because there's some really good questions come through. And I know there's some of them are quite personal. So if you've put a question up on here and it's specifically to your own situation, we'll pick that up separately afterwards. But there's some questions on here which are kind of useful, I think, for the whole audience to benefit from. So someone says here, would you recommend a stocks and shares ISA?
Yeah, absolutely. In the right circumstances. So again, going back to the 3 rules of investing, you've got an emergency fund, you've got a 5-year minimum term, and you're happy to take a balanced approach. What an ISA is a nice tax efficient wrapper. So any growth that your investments generate, the taxman can't get his or her hands on. So an ISA is always a sensible place to look at investing your money. But again, it depends what your personal objectives are.
Yeah, I think I mentioned last time, a lot of people used the ISA as the vehicle to invest in, but the vast majority of people have it in the cash element, cash ISA. And I think what puts people off is the psychology, because the switch from cash to stocks and shares feels like a big jump. And it isn't quite as big as that. It's not literally stocks and shares in one company, but it's just the language. And I think when we learn more, that is again what builds our confidence and start to move some of that money across. And I showed that graph last week, which shows that how often the stocks and shares ISA outperforms cash ISAs and inflation. It was a lot.
Yeah, I think that's
I think I don't want to overrun too much. There is some really good questions there. They're a bit individual. So what I will do, we will pick some of those up and answer those for you. So thanks for jumping on, everybody. I just want to finish off on one thing though. And that is, yeah, so we're going to go again next week. So I hope you really enjoyed today. We want to keep this going, and I'd really love for you guys, there's a lot of you on here. When you come out of this, you'll be asked to give us some feedback. Please give us some feedback. We want to make this the best experience for as many people as possible. We know there's a lot of financial anxiety out there. We know a lot of it is unnecessary. Sometimes it's just information they need delivered in the right way at the right time. So on the questionnaire, it's going to say, score this experience today. It's also going to say, what areas are most important to you that we can focus on for next time and the next time. Now, last week, interestingly, the number one topic that people want to learn about was pensions in plain English. So we've got some great ways to make this word pension sounds a bit dull, but actually we can make this very interesting for you. Okay, so if you want to understand how that works and what you got to do, again, it's very much about what do you want at the other end of it. But we're going to share with you some fantastic examples and some fantastic content on pensions. Keep it really, really simple. So thanks for jumping on. Please spread the word. Tell your colleagues at work about it. Let's get as many people on as possible. Let's get everyone to benefit from this. I'm probably going to get Jamie on next week. There'll be other guests coming in future weeks, but your feedback is absolutely crucial. So please do the feedback for us. Let us know what's important to you. Score us, tell us where we're going right, tell us where we're going wrong, and we'll fine tune this and hone this to make this the best experience. So good luck to you. Have a great weekend. Looks like lockdown is coming to an end a bit now. Looks like we can go on holiday as well, the news this morning. So that's absolutely brilliant news. So there is light at the end of the tunnel. Everything's good. And let's get you financially fit, because that'll help you be physically fit and emotionally fit as well. So thanks very much for jumping on, everybody. Thank you very much to Jamie. And I'll see you all next week, 11 o'clock. Take care. Bye for now.